While China's big stimulus plan has failed to create a sustained run in the Shanghai and Hong Kong markets, it's led to some big fund flows in the ETF space. Joining us now to discuss, Andres Rincon, Managing Director and Head of ETF Sales and Strategy with TD Securities. Andres, always great to have you back on the program. And this is really fascinating because, yeah, it seems like on one front, the stimulus may have fizzled for investors, but the fund flows, what's going on?
Thank you for having me, as always. And we've seen incredible fund flows into this space as of late. And if you go back the last few years, it's really been more of a story of India for EM. And most of the inflows have gone into India, for example. China, as you mentioned, has fizzled a little bit over the last few years. Their growth has slowed down. Real estate is a big issue right now in China. And obviously, the Minister of Finance or the Ministry of Finance in China saw this, and they had the biggest monetary and fiscal stimulus that they've had in recent past. So obviously, this has fueled the market. And I think what we've seen is that the markets, although it's fizzled a little bit, like you said, is believing that this stimulus might continue, and it might be bottomless, let's say. So we're seeing a lot more buying in China ETFs globally. So to the tune, and just in the US and US ETFs, we've seen just since the announcement about $6 billion go into this space. And we're seeing some inflows in Canada too. So overall, we're seeing a lot more money go into the space. And I think it's more about people that have been underweight this space because of the risks in this space. They've taken this as an opportunity to basically go probably market weight, and this is obviously what's driving big part of the flows.
And you mentioned risks, of course, because even though money is flowing in that direction, it's still sort of unknown what China might get up to next. So that's a very interesting one. Lots to talk about since you've been on again. Last time you were on, the launch of private asset ETFs. That was a big topic in the industry. What about a little bit of an update? What's happening there?
It continues to be the talk of the town when it comes to ETFs. Every single issuer is now talking about it. Every single market maker is talking about it, because we do believe that this might be the next frontier for ETFs globally, really. And in terms of, there's $13 trillion in assets in this space, and very little is being touched by ETFs today. Since the State Street filing for their private and public ETF in the credit space, there's been many more filings in this space for bond blocks and many other ones. Most notably, what I would say is there's been a lot of talk amongst the very large issuers about ways that they can get into the space, or ways that they're already looking to get into the space. So we had BlackRock before this, though, acquire Preqin, which is really an indexer of private assets. So this is basically all these issuers working together to try and find out a way that they can put a price on private assets on a daily basis. So the entire industry is now on full force working on how to make this happen. Now that State Street basically ignited the fire, what we're seeing is the industry as a whole really rushed to the gate, and they all now are in a race to launch the first one, or the first biggest and most successful one. Because as a reminder, the State Street product is only 15% of the portfolio, so it's a small part of the basket. But we do believe that this might be a gate into a larger holding into private assets, and that's where I think a lot of the discussions are.
All right, so obviously there's a lot of interest and excitement around that space from the industry. What are the risks there if an investor's thinking private assets? I've never really thought about them before.
For sure. So private assets are very popular amongst the wealth community. Why? They tend to be one of the big attributes of that, because often they're locked in. You can't just go in and out every single day, because there tend to be assets that are not public, or a building, let's say. So it often adds or reduces the volatility of a portfolio, because these assets in itself don't get quoted or priced every single day. Doesn't mean that they couldn't move, but they don't get quoted or priced every day, so which means that the volatility of the statement volatility, or the risk of that, is a bit lower. So what a lot of investors look for is they want that lower volatility, and often these assets come at higher yield given the often higher risk of these assets. So that's why a lot of investors are looking for that, and they're trying to democratize access to that, which is why it's being brought up in conversations with regards to ETFs.
Interesting space to watch when you're weighing the opportunity and the risks there. Another trend I think that you've been doing some work on lately, in the mutual fund worlds, we're used to different classes. Some ETFs have different classes as well. What's going on there?
So Canada has been a leader in this space for many years. We've had an ETF, what we call an ETF series, or an ETF class, for the longest time in Canada. It's not a problem from any issuer to just launch an ETF series. In the US, you can't. Without getting into the weeds, there are some regulations. There are some issuers that can, Vanguard can in the US, but that patent recently expired, and a lot of the issuers are now trying to get into that space. One thing to think about is that when the ETF structure was created, one of the main benefits of the ETF structure is that it externalizes costs. So every new investor that's coming in and out is coming in and out and paying their way in and paying their way out. That means that the investors within the fund do not get impacted by other investors coming in and out. That is one of the beauties of ETFs, one of the things that allow the ETF to be often a cheaper and most cost-efficient structure. When you have an ETF series, what ends up happening is that all those costs get pulled in because you are sharing assets, or the ETF series is sharing assets with a mutual fund, for example. So in this case, it's all commingled. So that's one of the, let's say, downsides of having an ETF series, but there are also some positives. At the end of the day, you have track record. If you launch an ETF series of a mutual fund, at the end of the day, you have that track record that mutual fund has had for 5-10 years. So it's something that a lot of people like to do, look at the track record. You also are sharing the costs of the fund. If you have a $2 million fund versus a $100 million fund, then obviously that cost is shared amongst all the unit holders. So sometimes it actually is advantageous to be part of the larger pool of assets because you're sharing in all the costs, all the fixed costs of a fund, for example.
Interesting stuff there to weigh out as well. Tax law selling season. I can't even believe that this is a topic that, no, come on, it's like, it's almost November. People need to start thinking about it. What does that do to the ETF space?
Yeah, and we're seeing it already. And as you know, I can't really talk too much about taxes or what can investors do.
We can't give any advice.
But I can talk a little bit about what we see in our space when it comes to tax law selling. And this is the season, as you mentioned. We're already seeing a lot of activity in it. Although this year is a bit interesting given that the markets have done so well that almost all areas are outperforming and they're in the positive territory. But there are some select areas that have not done as well. Some of the banks in Canada, for example, clean energy, that sector specifically hasn't done as well this year. So there are some pockets which haven't done very well. What we see often is an institutional client or an advisor, let's say, come in and they'll have a position that is underwater for this specific year or a specific period of time. And then what they'll look to do is they'll look to replace that exposure with an ETF. So obviously, if you want to crystallize that loss and at the same time maintain some of the exposure to that market, you can use an ETF that's highly correlated to your stock. And so there's many ETFs that have or hold decent positions in these stocks. So therefore, the best way to do is sell out of that stock, buy that ETF for a period of time, and then sell that ETF and buy back into the stock. So we're seeing a lot of that in the market, a lot of switches to maintain that exposure and realize those losses.